I want to start with the news of the day, which is the coronavirus, given the fact that we've already seen some trepidation in the IPO market with Casper, for example, getting a valuation from prospective IPO investors lower than recent private market funding rounds. How much do you think the recent jitters will dampen the IPO market?
Well, the important thing about the IPO market is the returns, and investors have made very good returns in IPOs in 2019 and so far this year. The reason is that investors are pretty price sensitive, and they're not taking high valuations. They're cutting those down in order to make good returns. Now, the problem we have coming into 2020, we knew we have the election at the end of the year, and that usually dampens activity. But now we've got the virus, and what that is going to do is that is slowing down the companies that are lined up to go public this year. Warner Music is set up. We haven't seen that deal launch. We haven't seen the deals for Cole Haan. They're on. Madewell is on the calendar. AZEK is on the calendar, an alternative wood company. So we have a very slow start now. Coronavirus is hurting issuance and will, because when the markets are volatile like this, IPOs just don't get done. That's a problem. IPOs are like the canary in the coal mine for liquidity in the private markets. And it looks like the liquidity is going to be shut down for a little while.
All right, so let's build on that. The idea being that even Casper, which was the roadshow was started before the coronavirus fears started to pick up steam, was seeing valuations in the IPO market substantially below the last round in the private market. What do you take from that?
Casper isn't the only one that's had these problems. I mean, Casper had a private valuation of $1.1 billion and went public with a valuation of a little below $500 million. A huge cut, but it's not the only one that's had this cut. It's because the IPO market, it's not like 99-2000 when retail investors were jumping in with both feet. The IPO market right now is a very price-sensitive place, mostly institutional and hedge funds, and these pools of money, they're not in the market to lose money. So they're not going to jump on the last round. And it tells you that the private market has very excessive valuations. That's what the public market has had a hard time reconciling.
What would you say to people who push back on that and say, well, actually, the companies that are going public are the weaker ones, are the ones that are not necessarily turning a profit yet, even though they're later stage, and that there still are a lot of private market valuations that make sense?
Well, at this stage in the cycle, I would say that the strong ones have come out, and it's the weaker ones that are trying to get out now. And the private investors are trying to get these companies in shape so that they can show the public market a kind of narrative, the business story that makes sense and a valuation that makes sense. The reason for the lockup in getting liquidity is that the private investors don't want to take a markdown in the public market. That's why they're waiting. It's like selling a house and knowing if the market's weak, you have a high price, you wait to sell until you think you can get a better price. But I think they're waiting too long.
Is there a historical comparison to what you're seeing right now in the prospective IPO market?
We haven't seen anything like this. I mean, we've been doing this for 30-some years. I mean, it's a complete flip-flop from what the market was perceived to be during the internet bubble, a complete flip-flop. But it's sort of the price discovery, the way the IPO market is trying to figure out how to absorb these companies. They have to fit in to the public company landscape. It can't be some crazy valuation when the rest of the peers are trading at a more rational valuation.
You spend your days crunching the numbers, looking at the fundamental balance sheets. How much do you think that private market valuations right now, as a whole, based on what you've seen from prospective IPO candidates, is overvalued?
A lot. Could it be 30% more than they should be? It's hard to have that. That's a very hard piece of data to get. But for us, it appears that they're very highly valued and valuations need to be cut. That's why these companies are waiting. They're thinking time may help with that better valuation, but I don't see it happening. Right now, the average company that's private is 11 years in private hands. You know, you're not a private investor to stay in these forever. You've got to find liquidity.
Well, here, we had Tony Tutrone of Neuberger Berman just on, and he was saying the one unique characteristic of private equity money is that there is a pool of capital committed to keeping those companies afloat and sufficiently funded through their history. So what's sort of the catalyst here to sort of call the hand on valuations that you see as excessively high?
That's a very good point. The catalyst, I think you can look at the IPO market as a catalyst. If the IPO market shuts down, which is happening now, and we're not sure how long it will be, then one path to liquidity is gone. if the market is telling us that we're in a recession, private companies are businesses just like public companies. So if those companies are stressed, they don't have as many avenues of liquidity. The trigger would be the closing down of an avenue of liquidity, which would be the IPO market, and then also some kind of business slowdown that says, how many can I keep these companies going who need additional capital?
Kathleen, just real quick here, is the reason the IPO market is shutting because of the coronavirus, or is it was it slowing before that?
No, the market was very healthy coming into the end. It is slowing because of the coronavirus, and that's an unexpected thing. So be warned if you're looking for liquidity in the public market.